Welcome to Zoom at 8. My name's Julianne Peterson, and I'm your host tonight for Zoom at 8. I'm here every Tuesday night. We've been doing this for over 3.5 years. I am a loan officer, senior director at Old Capital Lending. So my main focus is selling loans, and we do a lot of loans, especially in the great state of Texas. But we are a nationwide mortgage broker. So if you're underwriting and looking for loan products, I can help you with that. We do bank, bridge, agency, CMBS. I've got some folks that come here that do gap funding. I can do some private loans. So I'd love the opportunity, but I'm also known for helping you find sponsors, for connecting you with whether it's an attorney or a cost segregation. That's why I put together Zoom at 8, was to help folks kind of put their Rolodex together. And you'll find a lot of your partners here at Zoom at 8. Once we do our introductions, I am thrilled tonight to be able to have a productive conversation with Greg Willett. And you and I are going to learn so much tonight about the markets, what's happening, rent growth, population growth, where we should be looking, and what's happening going forward 2023. So without further ado, let's get on with the show. Tonight, I'm really pleased to announce and give you the floor over to Greg Willett. He is the first vice president and national director of IPA Research, which is Institutional Property Advisors. He spearheads research for the Institutional Property Advisors, which is a division of Marcus and Millichap. He weaves an array of economic, demographic, and multifamily asset performance data with meaningful market nuances in order to assist institutional and private investors as they form and execute successful business strategies. Greg is well versed on market fundamentals and activities nationally, by metro, and in individual neighborhoods. His commentary is featured in US and local media and in numerous news and informational sources focused specifically on real estate and housing markets. Greg began his tenure in the multifamily industry as a research consultant, specializing in feasibility evaluations of apartment property development, and he is the former chief economist for rental housing technology provider RealPage. Greg holds a bachelor's degree from Western Kentucky University and a master's of liberal arts degree from SMU. He resides in Dallas, and I am so pleased to have him here. So if everybody would give him the attention that he deserves, go to the right-hand side of your screen. There's a little thing that says view. If you would please open that up and go to speaker view so we can give Greg all of our attention. So Greg, welcome to Zoom at 8. So glad you're here.
Awesome, Julie. I appreciate the opportunity to join you. I want this to be pretty conversational, so I didn't package up a big slideshow for everybody. I just have some organized thoughts, and we're going to have some pauses in here where I hope, in fact, you're going to join into the conversation. I've arranged it in 3 general topics. First, I want to talk about the economy, and I'm approaching it from the standpoint of what's going to happen with renter consumer demand over the near term, and what sort of headwinds and tailwinds are we seeing in the economy. And I'm going to throw out a couple of key pieces of data and topics for you to follow that I think maybe are not getting the full attention that they probably deserve, that are going to shape what actually happens over the next year or two. Part two is, having really talked about demand, let's talk about the apartment market overall. What's going to happen with the general performance, what's going to happen with vacancies, what's going to happen with the rent numbers, and to some degree, how is that going to vary across different parts of the country, and urban versus suburban, by different classes of product. So just get a general perspective of our expectations of what will happen to the apartment market performance in the from the forecast that IPA and Marcus and Millichap have put together. And then part three of the discussion, and this is by request from Julie, I'm going to talk about some individual markets, and in particular, I'm going to talk about some smaller markets across the country. And Julie, you did a great job of plugging my LinkedIn, but I have a series that's called Small Market Friday. And every Friday, I actually talk about a different smaller market across the country, which forces me to dig into that data that I think a lot of people ignore. A lot of analysts ignore some of these smaller markets. And I get a feel for, I can also see what attracts eyeballs on LinkedIn. And so you sort of get a feel for general level of interest in these small markets across the country. So having set that up, let's begin with what's happening with the economy and what does that mean in terms of consumer demand for apartments. And if you have been tracking the data, you know that we have had a couple of really, really weird years for apartment demand. And if you look at the average for the past couple of years, it's around 350,000 units absorbed for the nation as a whole. That's a solid and strong number, but the pattern was nuts. Calendar 2021, it was 700,000 plus units absorbed. If you look at the previous 30 years, the highest we've done in any year was 400,000 or so. So, I mean, that was just off the charts by a phenomenal number. And then we got to calendar 2022, and the number is basically zero, depending on which data source you look at. It's slightly negative to slightly positive. So that's concerning that we essentially didn't gain any occupied apartments in the course of the past year. So that brings up the question, what's going to happen next year? Will that demand number get back on track? So as we're thinking about the economy, let's start with the job numbers. And while throughout the past year, there's been this discussion of, hey, super high inflation, to combat that, we're going to have to go into recession and look for the economy to slow down. But in fact, we had some pretty stunningly strong job numbers in the course of calendar 2022. We created in the nation as a whole about 4.5 million jobs, a very, very solid number. If you look at the monthly production, we did start to slow down toward the end of the year. If you look at the December number for US job production, that was about 223,000 jobs. A lot of economists referred to that as a Goldilocks report, that it was not too hot, not too cold, a very healthy number that might be sustainable. So that was encouraging. And if you look at the current unemployment rate, it is only 3.5%. That's a very, very low unemployment rate. That what's considered full employment is 4.5 to 5%. So there are lots of companies out there who actually can't find the people that they would like to hire. Let's talk about what the Fed is doing and the expectations they have. And in order to bring down inflation to a level that's more palatable than what we're seeing right now, the Fed is targeting that we have an unemployment rate that goes back to that norm of 4.5 to 5%. For that to happen, the US has to lose about 4 million jobs. So that's sort of the set. I mean, that's really the Fed's target over the next year, is to have those job cuts in order to cool off inflation. So it is, and I think that as mid-year, I think that pretty much most economists really thought that we were headed for that recessionary environment. At this point, we are starting to see some economists think that that soft landing is possible. And soft landing would be a situation where you cool off inflation to a reasonable level, but you actually don't stall out what's happening in the economy overall. That's hard to do. But I will point out that, in fact, it's kind of actually happened to some degree in the past, in that we've had what have been rolling recessions hitting some industries, but not taking down the whole economy. And we're starting to sort of see that right now. Clearly, we are already in recession in the tech sector. If you're reading the headlines, there are significant job cuts that are occurring among a lot of tech employers. It's true that the housing market is really essentially already in recession, and commercial real estate is in recession as well. Can you do that and not have it happen in the overall economy? Maybe. I will say it seemed like that was, going back to past recessions, that was the situation that we were experiencing in the late 1980s.
Let me fix that.
Sure. So that was what was happening in the late 1980s, and it looked like we were going to avoid overall recession. But then the Gulf War happened, and oil prices spiked, and that pushed the overall economy into general recession. So again, it's in select industries right now are beginning to struggle. I will point out that the ones that I mentioned, tech, housing, commercial real estate, beginning to show up in some professional services sectors, these are high-paying jobs. So really somewhat unusual in a recessionary environment. We might be on a path toward what economists are calling a recession, in that it's the high-income households that will experience the most pain. And I'll point out, high-income households are already, to some degree, feeling pain, because these are the households that own stock. And we've had this huge correction in the stock market. So to the degree that there's pain out there, it is the more affluent households. And let's think about that in terms of the apartment market. These are the households that rent that Class A luxury product. So that puts us perhaps in more danger in that segment of the market as we move ahead than we have been in the market overall, and particularly in terms of bread and butter middle market product. That outlook is probably a little bit better given what's happening in the economy. So having touched on the job market, now let's talk about these inflation numbers, which again, the Fed is pushing us toward possible recession because you're trying to get inflation under control. So while I think of what's happening in the job market in the coming year is probably a headwind for demand for apartments, what's happening with inflation is probably going to be a tailwind in that inflation seems to have already peaked. Our current number, annual increase in prices is a little bit north of 7%. If we go back to the middle of the year, that number was about 9%. So it is starting to slow down to some degree, and be aware that the biggest impact on these inflation numbers right now are shelter costs. And so it's what's happening in the housing market, including both for sale product and rentals. And the way that the Fed measures housing inflation is very backwards looking. And so if you look at the current inflation numbers, they still show that housing costs, the pace of growth in housing costs is still accelerating. But in the industry we're in, we know that's not true. That in fact, rents have already, the growth pace has slowed down in really everywhere. And there are a handful of spots where in fact you're backtracking on rents. And so these housing cost measures will be rolled into the inflation calculations over the course of 2023. And that almost by definition means that in fact, the overall inflation number that the Fed uses is going to come down. So that I think will be something that will help with demand for apartments. Now, having said that, I'm going to throw a wild card in there that virtually nobody is talking about right now, and that's China. And so they have just changed their policies that they're not really in lockdown anymore. They're allowing people to travel. And COVID is not under control in China, and they have a different set of vaccines than we've had in the Western countries. They're not as effective. We're talking about millions of people coming down with COVID in China, right in front of us. And so is that going to spread to other parts of the world? Maybe. And is it also going to shut down Chinese manufacturing, which, let's think back when we were in 2020, we had these supply chain disruptions and there were products that you couldn't get. And that was one of the factors that really triggered inflation to begin with. So are we setting up a situation where that could happen again? Maybe. I would say, thinking about what's going to happen in the world moving ahead, pay attention to China, that in fact, it can end up impacting the US economy more than you realize. It can impact demand for housing, including apartments. And then one other factor that I think is getting ignored that I want you to pay attention to is what is happening with consumer confidence. And it's not that consumer confidence drives apartment demand, but there's an incredible correlation between those measures. And one of the key reasons that we didn't have demand for apartments in 2022 is because these consumer confidence numbers were so low. people concerned about inflation, people concerned about what's next for the economy, even though the overall numbers were still pretty good. And that caused people to kind of freeze in place. And there was not much mobility. And when you're nervous about the future, the tendency is you do nothing. And so we saw apartment demand falter, even though the economy was generating pretty good numbers of jobs. Encouragingly, it looks like that consumer confidence number has hit bottom and is now beginning to pull up a little bit. We've had a little bit of growth in that confidence number for the past couple of months. A new set of data comes out on Friday of this week. So we'll be watching that to see what that means. So putting all this together, addressing the question of will there be demand for apartments in 2023 or will there not? Our answer, according to the analysts at IPA and Marcus and Millichap, is yes, there will be demand. It's not going to be great demand, but we do think it is positive. Our number for 2023 is demand for about 227,000 apartments across the country. Again, not a huge number and even below the average for the last couple of years, but certainly some progress from that number of basically zero that we recorded in 2022. So that's what I wanted to say about the economy, setting some big picture story and things to think about. I'm going to pause here, take a breath, let you guys jump in. Anything that you want to talk about, explore further in the economy. And I see a comment on new supply. That's the next topic as we explore what's going to happen with the apartment market. Is yes, we do think demand comes back, but it's going to fall short of deliveries next year. But anything we want to explore on the economy?
Anybody unmute yourself and we can ask the question.
Don't you think it's a little bit market specific? Like, for example, the effects of inflation or the economy is going to be felt differently in, I don't know, Detroit versus Dallas as an example, or New York versus, San Francisco, and therefore the demand for apartments. And also within apartments, the class of apartments, A versus B.
Sure. And no, it's a great point. And it's always different from one part of the country to another. But I'm going to point out something I said in terms of what industries are struggling at this point. And it is those high paying sort of jobs, which is normally a good thing, but and in particular right now we've got cutbacks in tech, and so a market like the Bay Area or Austin or Raleigh could actually be while those are great, traditionally have been great employment markets, and you create a lot of high-end jobs and that creates demand for luxury housing. Those are places that are going to be vulnerable over the near term versus places that tend to be slow and steady actually can end up moving toward the top of the list. So compared to its usual position, Midwest is probably going to outperform where we are. So yes, there certainly are some differences from place to place. And I think the apartment market is going to behave very differently by product sector, which is what another point that I'm going to get into a little bit more next.
Perfect.
All right. Why don't I go ahead then and jump into our overall outlook for what's going to happen in the apartment sector across the U.S. Again, the topic of construction was brought up. There are 900,000 or so apartments under construction right now in the US. Scheduled deliveries in 2023 are about 500,000 of those should complete. Now, our number in our models actually is a little bit lower than that. We think it'll be closer to 400 because you actually just don't have the construction workers to complete 500,000 apartments. I mean, if you look at deliveries every quarter, it tends to be 80, 90,000 at the max, 100,000. So I don't know how completions, when everybody's going as fast as they can already, suddenly go up by 100,000 units or so. So we think the number is going to be about 400,000 units completed. But again, I told you our assumed demand number is 227,000. So that means that vacancy rates are going to go up. Our expectation is the vacancy rate goes up to a little bit north of 5%, 5.3% by the time we're at the end of this year. That's up 80, 90 basis points from where we are right now. And I'll point out vacancy went up a lot during the course of this past year. We were at early in 2022, we were at an all-time low vacancy rate that was 2.5% or so. So we've actually had some pretty significant movement. But again, we think it gets to a little bit north of 5. And 5 is not a bad number. 5 is actually pretty similar to the historical number. So that's okay. I'll circle back to, hey, we think there's going to be demand. But if there's not demand in 2023 and we deliver 400 to 500,000 units, suddenly you're talking about vacancy that goes to 6 to 7%, which would be a pretty challenging environment. So rent growth, we think that the US number is probably a little bit above 3% increase in the coming year. That is, again, not an awful number, but it's going to be a little bit probably below what the inflation number is. And if you look at the past 2 years, 2021, the rent growth number was a phenomenal 17% for the US. I mean, obviously, that is not sustainable. Looking at the 2022 number, the final numbers are just coming in right now. I think if you look in change in overall effective rents, including the high price new product that's been completed, that's growth of about 9%. If you measured it on a same store basis, most individual properties had rent growth around 6%. So we think, again, the coming year, you're coming down meaningfully from where we have been, but we do think that that overall number is a positive number. And as we look across the country, we think that performances from metro to metro are converging to some degree. Again, back when we had that peak growth, you had places that were getting 25 to 30% rent growth. The most aggressive number we see anywhere on the metro level in 2023 is between 5 and 6%. Probably that's going to happen in some of the Florida markets, and Texas markets are going to do okay, tending to be a little bit above the US, but not superstars. And then our lowest number is in northern New Jersey, which is getting a whole lot of construction and is not a big job production environment to begin with. We think that the rent growth there is probably about 1%. So I'll point out that means we're saying there's not rent cuts anywhere, but there will be some places that will be vulnerable. The two that stand out right now on an annual change basis, they actually did go negative in December. It was Phoenix and Las Vegas. So some caution there. And again, I mentioned places like Austin and other tech markets that you could see it. The worst case scenario that could emerge in those markets, you could get, rent change down to basically nothing or slightly negative. So again, some convergence of the numbers across metros, and also after the suburbs have well outperformed the urban core in recent years, we again think the numbers are pretty close in terms of rent change for the urban core and the suburbs in the course of the next year. So again, differences in performance generally being compressed, with the exception of if you look at the numbers by product sector. And everything I've talked about is that challenging environment at the top end of the market, which is probably going to have lesser overall demand. You have all this new product coming online. So we think that the rent change numbers in that Class A luxury space will trail what you see in the middle market. And there are going to be lots of places across the country where you have probably essentially flat rents for Class A product in the course of the coming year. So that's our basic scenario we've got for what happens in the apartment market. So again, I'll take a breath, give you guys the opportunity to ask any questions before we talk about some specific markets that I think are opportunities, and particularly looking at those small markets.
I would ask, you brought it up, Phoenix.
Mm-hmm.
Let's touch on that, or is that going to be in the third section?
No,
because
it's fine. Let's talk about Phoenix. I will point out the Phoenix performance over the past decade has been phenomenal, and both the rent numbers and the price of product, the value of assets, grew drastically faster than the US norm and drastically faster than other Sunbelt markets. I mean, if you were to compare Phoenix to what happened in Dallas or Houston or Atlanta or Charlotte and Raleigh, I mean, the Phoenix numbers are off the charts. So did Phoenix get overheated? I would say it did. And so you've got some correction that's happening in Phoenix. That's true to some degree in Vegas. I mean, there are some small markets in that mountain desert region like Boise, where again, you're seeing that same pattern where things just got to unsustainable levels.
so when you're talking about this, and I know that Sandhya just mentioned, what about Class B and C? If we're talking about Phoenix A class, when you're talking about Phoenix as a whole, or is this just A class? What do you, when you're delivering that message about Phoenix?
Phoenix is challenging all around, I would say, and I'm going to point out that the amount of product that's still under construction and about to be delivered in Phoenix is huge. And again, I've been in the industry a long time, and one of the people who worked for me years ago just recently made the point to me, it's like, one of the first things you ever said to me was, when the construction numbers get big on the west side of Phoenix, that's when you know the cycle is over. And I will say that, point out that Goodyear, Avondale area on the west side of Phoenix, there are 8,000 units under construction in that one submarket alone. So I think we just got over our skis in Phoenix, and there's going to be some short-term pain in this one.
It's amazing because I hear so many people saying, I am bullish on Phoenix. I'm bullish on Phoenix. And, you know, I want to encourage them, but I also want to say, if you look at some of the top investors there, they're shifting their focus and they're moving to other markets.
And this is not to say that Phoenix is not a good market in the longer term and in the big picture, but
Right.
I think we've got a couple of years where Phoenix is going to struggle, and we have to give back a little bit of the overachievement that happened during this last cycle. And if you measured what's the 10-year change, Phoenix would still look great and would be outperforming the US. So I'm not saying don't consider investment in Phoenix, but also don't expect good numbers for the next couple of years.
Yeah, makes sense, makes sense. How about the impact of the water? Is that something that needs to be considered?
I will say it's not something that we address in our modeling. You sort of look at when you're modeling, there's a range of outcomes that are possible, and you sort of view these overall influences that you can't pin it down to a number as guiding you whether you should be aggressive or conservative in your general outlook. But we're certainly not attempting to model water supply or climate change in most of these markets. We're sticking with things you can see as in terms of you know, what's happening with the economy, what's happening with supply demand dynamics, etc.
Okay, good point. Okay. Anybody else?
All right, so we want to talk about some of these small markets, Julie?
Yeah.
Okay, so again, I put out stories every Friday on small markets, and let me give you a little bit of an overview of what really attracted a bunch of eyeballs in the course of the past year, which I think tells you what markets are people interested in. The best performing posts that I put out there tended to be on small markets in that mountain desert region, and particularly they did well in the beginning of 2022 and started to tail off as the year progressed. But the number one market that people read the commentary and explored and talked about was Albuquerque. And you also had lots of interest in Colorado Springs and in Tucson. I mentioned Boise earlier. Again, some of these, I would make the statement that, like Phoenix or Vegas, maybe they got overheated a little bit, although I do think that I'm going to agree with people that liked Albuquerque. I still like Albuquerque. I think there's runway. It was late to the party compared to other metros in the mountain desert region, and so it hasn't completely run out of runway yet. So I do like that one. So again, I think there's reason to explore some of these mountain desert markets, but be aware there's vulnerability to having gotten overheated. So those were the best performing posts for last year. If I'm picking personally, what part of the country do I like now? And these posts do well also. It's that Carolinas, Tennessee pocket. And maybe underappreciated, if you put North Carolina, South Carolina, and Tennessee together, you have the same sort of in-migration that you see in Texas and in Florida. There's a lot of people headed to these markets. And I'll point out that cities tend to be, you don't have huge cities in the Carolinas that totally dominate these numbers. So, I mean, the biggest markets are Charlotte, Raleigh, and Nashville. But if I looked at the 10 largest metros in the Sun Belt, the biggest one in that pocket is Charlotte, and Charlotte is only number 10 in terms of if I'm ranking the biggest markets in the Sun Belt. So that means you have lots of interesting smaller places. Like I'm super fascinated with Knoxville right now. I mean, this East Tennessee corridor. So Knoxville, Chattanooga, Johnson City. You jump over into North Carolina, you get places like Asheville and Wilmington. Go to South Carolina. Greenville's been pretty hot for a decade. My first Small Market Friday post of this year was about Greenville. We still like that one. Columbia, South Carolina has maybe been a laggard, but is now starting to look better. So I like this pocket of markets, and not that I'm necessarily recommending places. I'm just saying here are spots that I think it's worthwhile to go investigate. Is there it's a good big picture story, and if you can find the right asset, I would consider those. And then one other group of markets that I want to talk about, and every year, well, I'll say every year, for the past 2 years, annually, I have produced a list of the opportunity markets that are college towns. And I love this college town story because you get the job quality tends to be better than in markets of comparable size that are not college towns, simply because you have a better educated workforce. You have you have cultural amenities that come with colleges. It's an interesting lifestyle. So these are solid places to live a lot of times. I will point out in our rankings of college towns for calendar 2022, the number one market, I've actually already mentioned it, was Knoxville, Tennessee. Slightly doing better than Ann Arbor, Michigan, and Boulder, Colorado. So Boulder then jumps back to that mountain desert sort of storyline. Knoxville hits that Tennessee, Carolinas storyline, and then I will expand or I'll zero in on the college towns that actually what you could have dominate the list of all. If you were picking top 10, you could make a case that all top 10 would be Midwest college towns. And so Ann Arbor was in the number one spot, but you could make a strong case for Lansing, Michigan, and Kalamazoo and Grand Rapids. And you jump over to Indiana, and both Bloomington and Lafayette are really attractive markets. Got a ton of views whenever I talked about Madison, Wisconsin on Small Market Friday. I like this Midwest college town story.
Okay, so let's talk about that, because as a lender, we are not happy with college towns for financing. I mean, we really are struggling with doing financing on student housing, right?
Well, and I'll point out, my list is it worth exploring conventional product? Because student housing in and of itself is a different animal, and I'm not surprised that it's harder. It's student housing in and of itself tends to be either a home run or a strikeout, and it's never in between. from my perspective.
It's on or off, it seems like.
Right.
Yeah. I love these cities. I think they're fantastic. I think there's great opportunities. Lansing, all of those that you mentioned are all places that we should be looking at. Indianapolis, not that there's a college, but I think that's another great city that you're talking about. Okay, cool, great. Any other points on that before I interrupt you?
Yeah, no, I'll leave it at that. I love, and again, we highlighted those areas, but our college town list actually was pretty wide ranging, and other examples. Waco actually made the list. Fresno, California actually made the list. Charlottesville, Virginia, one of the Florida towns. Where is the University of Florida? Is that Gainesville?
Fayetteville.
That was and Fayetteville, Arkansas was sort of an honorable mention sort of market. The challenge there is rents are really low, but still but growing. So again, we like that college town story.
Excellent. Okay, I do think that there are some questions here. Huntsville, Alabama. What's I know we did see some of those a couple years ago. What's your thought on that?
Love the economy, and when you're going into recession, rocket scientists don't lose their jobs. Usually that's what you have that sets Huntsville apart from other markets in that part of the country. The construction volume, and this one is not under the radar at all. The construction volume is gigantic. So, has, I think that developers and investors, if you're looking at Huntsville, they've already beaten you there, and that, the best deals have already been done in Huntsville.
Okay. What about Augusta, Georgia? That's has been a tough one. It's been some people say it's regentrifying itself. Some people say not. There's opportunities. What's your thought on it?
I don't feel strongly about that one.
Okay.
And I will say that whenever doing Small Market Friday, I've looked at that one and considered it a couple of times, and I can't come up with an interesting story to tell in Augusta.
Okay. What about still staying with Georgia? What about Macon?
The Georgia markets are, it's solid numbers, at to above the US numbers. Again, as I'm kind of looking and telling these Small Market Friday stories, the challenge is there's nothing that really stands out in these Georgia markets, one against the other. I mean, they're pretty similar in terms of performance. And so it's okay, but not, I wouldn't put it in the top tier for the most part.
So, but it's not Phoenix.
Correct. I mean, again, they're solid numbers. They're similar to the US. But again, as I'm thinking about these and I'm doing blog posts on them, you would just want something interesting to say. And hey, here's a market that looks like the US overall. Is not a very interesting story.
Got it. Okay. I'm hearing a lot about Des Moines, Iowa.
Yes, but it's a pretty big construction market, and over the course of the past year, it's been a laggard on rent growth simply because you've introduced so much new supply, like the economy, and the the deliveries have leased very well, and vacancy has stayed low, but you haven't been able to get any rent growth.
So we've got all of this new construction coming on board. That's going to affect how is B going to be sitting in this? Is that really going to struggle on the B's assets. Tell me how that, because a lot of us are looking for B's.
Right.
Yeah.
From our perspective, there's a pretty big price difference for the rent from an A to a B. And if you go back, you know, I'm old enough that early in my career, if you were hitting a stumble in the marketplace, it was that flight to quality, and there was the idea that you could reduce your rents in the top tier, and people would move up from B to A, and the difference in price was small enough 20 years ago that could happen. But now, if you take a sizable discount in your A product, people who live in B still cannot afford that.
Okay.
So I think you have a more stable environment in B than you do in A, which is impacted by the new construction, and also than in C, which is always vulnerable to, just because the renters just don't have any sort of cushion if something goes wrong at all, that if you have a stumble in the economy, you're always risking people are turning in their keys and moving out, or just not paying rent, which actually is in some places a challenge in Class C product already.
Yeah, makes sense. Makes sense. Great. Okay. Anybody else? Recently visited Huntsville. Seems like they're exploding over there.
Again, it's a great economy. It's produced a lot of demand for apartments, but there are a lot of new apartments, pretty expensive high-end apartments that have just been delivered and are still under construction in this one.
Yeah. Armando, what do you got for us?
Sure. Hey guys, how you doing? Hey Greg. So I have a question. So I know you said that Georgia is very similar amongst itself, but you know, I live about 15 minutes north of Atlanta. So if you were going to invest in Georgia, especially any kind of like secondary or like any kind of the tertiary markets, can you kind of give me an idea of like good markets to invest in?
Yeah, well, again, we think that these are we like that Southeast story. And again, the Sun Belt story in terms of, I'm just a fan of the strategy of get in front of demand. And in terms of economic expansion and in migration, people moving from one part of the country to another. Again, you have these three stellar pockets, which are, as I mentioned, North Carolina, Tennessee, state of Florida, and the state of Texas. But the rest of these Southeast markets are pretty solid numbers too. The Georgia numbers are good. The Alabama numbers are pretty decent as well. The Virginia numbers are good. Having generalized, I will point out the Mississippi and Louisiana numbers are not good. Particularly the Louisiana numbers are not good. But otherwise, I don't know that you have markets in this part of the country that I would necessarily be afraid of, but you do need to watch the construction levels. And so there are places like Huntsville and some of the small Florida markets where there's just a lot of product coming.
Amazing.
And then one other point to throw in there in terms of Georgia itself, look for, is there a compelling storyline beyond just the fact that it's in that part of the country and it's appealing lifestyle. And then when I would circle back to the port in Savannah, obviously makes this a different economic story than other similar sized markets.
Yeah, makes sense. Moses, what do you got?
Thanks, Julie.
Sure.
Greg, I typically use the IRR.com viewpoint report, and they came out with their 2023 and they have Charleston, South Carolina in that hyperextension phase there, and that was kind of shocking. Could you give a take on that? I mean, I'm looking at what you're saying about the the Carolinas and the Georgia credit, and to see them in there, I was surprised.
Yeah, I will say that when I started the Small Market Friday blog, it really stemmed from an internal discussion of, is there another Charleston and is there another Greenville out there in the world? That those two markets have done so incredibly well and punched way above their weight during the course of the past decade. So Charleston has done well, but it has, over the course of the past decade, in terms of the percentage growth rate in inventory, Charleston has added more product than anywhere else in the country over the course of the past decade. So again, it's leased up. The numbers have been strong, but you have to be careful what happens with rent growth when you're delivering that much product. And so in terms of, there are points in time where Charleston does get over its skis, but it tends to be, it lasts for a year or two. And then, but again, I love this one in the overall picture, but there are points in time where it's going to be challenging.
Muthu, do you want to ask your question?
Yeah, thank you
Sure.
for all the insights. I was just curious about Houston, right? Compared to, say, Dallas or, and I gave an example of Jacksonville or Atlanta. I think more of it has to do with the energy market, but now that the energy is doing well, what's your take on Houston?
I always say, when I'm looking at Houston relative to the other markets in Texas, there's an overall storyline for Dallas-Fort Worth. There's an overall storyline for Austin. There's an overall storyline that's becoming a much more interesting storyline than it has been historically for San Antonio. For Houston, never think about the metro numbers when you're deciding whether or not to go into Houston. It's about the neighborhood. It's about the individual deal. If you look at the metro numbers, you can never justify investing in Houston.
That's interesting. You talk about San Antonio. Was it today's post that you had mentioned about San Antonio?
Oh, I did. So today's post, I talked about what will be the rent growth leaders in Texas,
yeah.
For this year. And for the past few years, it's been Austin by a pretty big margin. I think I've mentioned already some challenges that Austin has with a tech-based economy and so much construction going on. So we think that DFW actually moves ahead and is the best performer in the course of the next year. Our weakest number is in San Antonio, but I'm gonna say that when you're modeling, you have a tendency to have the numbers move back toward what's been the historical norm. But I think during the last couple of years, San Antonio has become a fundamentally different market, partly because of the kind of jobs that have been created. And then also in a very big way, people are getting priced out of Austin, and San Antonio is right there. And so I think that future demand and future rent growth can in fact be better than it has been in the historical cycle for San Antonio. There are a handful of markets that over the course of the past couple of years, I think became fundamentally different markets. San Antonio is one of them. I would go to Florida and say Tampa and Jacksonville probably fall into that category. And then go to California, the Inland Empire, Riverside, San Bernardino is fundamentally different than it was a few years ago.
Yeah, I would agree with that. So with this kind of repricing, if you will, on and the cap rate compression kind of changing, taxes, or we're going to see it a little bit of a tax changing in Dallas, maybe in Texas, right? Maybe a little bit freeing up.
I would say, well, I mean, there's probably people on the call that are better experts on that than I am. I in terms of tax increases beginning to slow, my response would be wishful thinking, but we'll see. And even if that were to happen, what kind of counters that is acceleration of insurance costs, particularly in Texas and in Florida. It's challenging expense environments at this point.
And I think that's why a lot of people pivoted to Phoenix. I mean, they didn't have those two issues. It was like, oh, let's just go to Phoenix. They had the rent growth, right? They didn't have all of those crazy taxes and insurance issues. So it made, on paper, it made a lot more sense. Now, that's catching up to them.
Right.
Yeah.
Again, I just feel like it's always good to, while you pay attention to what's happening at a given point in time, it's kind of important to keep track what has happened over the course of an economic cycle. And I think if you had seen how much more aggressive the growth had been in Phoenix versus other spots over the past few years, that the caution flags probably were there to be seen.
Amazing. Just crazy, amazing. All right. Well, before we close up shop here, is there any final words of wisdom that you would like to share with us for investors?
I guess I'll point out, while we're not painting the best picture ever for 2023 and maybe first half of 2024, but in the big picture, housing is still very undersupplied across the U.S. And so and real estate is not a one-year investment. You're playing the longer game there. So we certainly like this sector in the big picture, but you got to be prepared that occasionally you're going to hit a bump in the road, and probably this year falls into that bump in the road category.
Yeah, oh, that makes sense. I mean, better than the stock market.
There you
right?
go.
So, well, thank you so much. Before we say goodbye to you, is there anybody in the audience that wants to say final question before we say we're on to the next?
Greg,
Jeff?
what's the house view on single family build to rent? Because I see tons of institutional capital going there. How does that play to the overall story?
No, it's a great question, and the demand fundamentals for this product segment are actually pretty favorable, and I think there's going to be some pretty strong demand, particularly if we get, with institutional sort of ownership, you're getting more efficient management and making it a really appealing living experience. So I like it. Is there too much money chasing this play? I would say probably. So we'll see. But I don't think it to me, it is a very different, for the most part, it's a very different renter audience than who rents apartments. So I don't think it necessarily takes away from the potential for apartment markets. But again, I like it. overall, but there's going to be a whole lot of money out there trying to get those deals.
Okay. Well, thank you, Greg. Once again, appreciate all your input, insight, direction. Really appreciate it tonight. You're a real professional and understand the markets. We really have learned so much from you tonight, and really look forward to learning more from you over the next many Fridays coming up. So make sure that if you are not connected with Greg Willett on LinkedIn, please look him up. Greg Willett, LLT, on LinkedIn, and look for his posts. They are really fantastic. And if you need to look up Greg and need to contact him, remember, his time is valuable just as yours is. Don't be reaching out and, asking him what his cat's name is, right? You got to be, having a useful conversation. His contact information is in the chat. So again, Greg, thank you so much. Appreciate your time.